Well, two or three companies in our core rising dividend strategy. We'll start with Aapl. I like to use fast graphs as a way to show price action dividends correlated with earnings growth. If we look at a 9-year chart of Aapl, you can see that Aapl over this period, including forecasted earnings over the next couple of years, is traded at a normal PE ratio of 14.5, and then actually coincides almost exactly with the operating earnings growth of 15.4. So we're within 900 basis points here of Aapl is traded at about 1 times its earnings growth rate. With the recent correction, Aapl now trades at 16 times earnings. You can see that earnings growth is expected to slow over the next couple of years, 13% in 2019 and 10% leading out to 2020, with the market not really expecting much in the way of new product introductions that are enough to move the needle for this $900 billion market cap company. Nonetheless, Aapl is expected to raise their dividend from the current $2.72 a share to $3.07 a share, and then to $3.37 a share looking out a couple of years. So that's about 10% earnings growth. At the same time, Aapl, through its buyback program, is expected to take about 4 to 6% a year of its share count away through buybacks. So earnings will grow by 4 or 5% a year simply by share buybacks, plus the dividend growth rate of 10%. I think it's pretty reasonable to assume that these sorts of PEs that are being shown for Aapl are normal. So based upon that, Aapl got probably a little too expensive here at the end of August at $227 a share. Based on normal PE ratios, that would suggest that Aapl is probably worth about $195 a share. Currently, it's trading at $193 a share. So Aapl is pretty fairly valued here. If you'd like to take a look at Aapl in terms of what kind of returns we can have, you can see Aapl is trading nicely within what I would call its normal PE channel. You can see that when Aapl is traded around $150 a share, it was pretty much fairly valued, but then you had a growth rate that would continue to support that PE ratio. If we look forward to the end of 2019 fiscal year, which would be through September of next year, at the current price suggests that Aapl probably should be trading somewhere between here and about $200 a share. You factor that along with some dividend growth, and you look like you can get about a 6 to 7% return on Aapl from current prices. So my conclusion when I look at this is that Aapl probably got a little bit ahead of itself when it was trading up in the 220 range, but today you have pretty good downside support on Aapl. If we take a look at another company, though, that doesn't look as good, and that would be Microsoft. Microsoft, on the other hand, is one of the stocks that has really had a hell of a run. And if you look at Microsoft going all the way back to 1998, you can see that Microsoft has really been a pretty amazing company, growing earnings from 77 cents a share in 1999 to 20 years later, growing earnings to $3.88. So that's a five-fold growth in earnings. And over that time, you've seen a nice movement up in the dividend. They initiated a dividend in 2003, paying 8 cents a share. In 2018, they're paying $1.68, and they're expected in 2019 to pay $1.84. So they're growing the dividend nicely. There's a good spread between their current earnings and their dividend paid, meaning they have lots of excess free cash flow. But that's really not the problem with Microsoft. The problem with Microsoft is if you shorten up the time frame to look at the most recent 11 years, you can see that over that time, Microsoft has grown their earnings at about 9.7% a year. This is actual earnings growth. So if you use the normal PE, which would take into account prior earnings growth plus future expected earnings growth of 15, 13, and 16%, you can see that Microsoft's normal PE ratio is about 15 times earnings. It's currently trading at 26 times earnings with a dividend yield of 1.7%. So a couple different ways we would look at Microsoft from a valuation perspective. If we look at Microsoft's dividend yield, you can see that Microsoft has historically yielded somewhere in the mid to high 2% range through the period in which they were raising the dividend without share price appreciation. But today that dividend yield has dipped to 1.7%. Also, if we look at the current share price today, it's trading at 114 on a PE ratio of 28. 28 at the peak, 26 today, would suggest us that no matter how we look at Microsoft, even if they hit their earnings targets and traded in a normal PE, there's a fair amount of downside in the shares of Microsoft in the event the market were to go into a protracted downturn. This math suggests that if Microsoft just trades at its normal PE, the stock is worth somewhere between $65 and $75 a share, currently trading at 108. It's similar metrics if we look at Microsoft on an operating cash flow basis. Microsoft generates an awful lot of cash flow. But even then, if we remove the dividend yield, you can see that Microsoft's operating cash flow has grown at about 10% a year. It's currently trading at 18 times operating cash flow. So if Microsoft were to trade down to its normal cash flow, you end up with about a similar projection of about $68 a share. If we take a look at Microsoft on a free cash flow basis, this is a company that generates tremendous amounts of free cash flow. Again, Microsoft's grown free cash flow at 8% a year, but it's currently trading at 24 times free cash flow. Now, that can be a deceiving number because they're investing lots of money back into their businesses. They're trying to grow out their Azure offering, which would be their cloud computing offering. But either way, no matter how you look at it, Microsoft currently looks like it has a cushion somewhere in the $70 to $80 a share range, and it's currently trading at 116. So this would be a stock in our dividend strategy that we consider to be very expensive. Third company I'd like to take a quick look at is Aabv. Aabv is the pharmaceutical spinoff from Abbott Laboratories. Took place 6 or 7 years ago, 2012. Aabv began trading. Aabv over that time period, let me convert this to operating earnings. Over that time period, Aabv has grown their operating earnings at 13.9% a year to trade on a normal PE ratio of 15.2. That would include estimates for 2019 and 2020, where earnings are expected to grow at 11% and 8% respectively. In 2018, Aabv's dividend is $3.84 for a yield of 4.7%, expected to grow to $4.28 and $4.69 in 2020. In January 2018, Aabv got pretty expensive, but still not overpriced, at least using the methodology that I like to look at. Aabv was priced at 19 times earnings, had reached $115 a share. Fast forward to today, the low recently at the end of October was $77 a share, and today Aabv trades at $91 a share. So you've had 14 points of appreciation since its low at the end of October, where Aabv got cheap. But if we take a look at Aabv, you've got a company here that's trading on a PE ratio of 12 and growing earnings at 14% a year. So if we were to just say, what's Aabv look like if Aabv trades at 15 times earnings next year? It's potentially $133 share price. So when I take a look at Aabv, what I see is that we've got a good cushion here, nice dividend yield, nice dividend growth, expected earnings growth. And if we look at our potential valuation ranges, again, as I said, if Aabv trades simply at 15 times earnings between now and the end of next year, you're looking at a potential total return of 43%. So I profiled 3 companies in the rising dividend strategy. Aapl, which to us looks fairly valued and should have a floor underneath it, I think somewhere in the 180 price range. We took a look at Microsoft, which is arguably the most expensive stock in our rising dividend strategy and will likely be trimmed. And we took a look at Aabv, which is one of the poorer performing stocks in our strategy with a 4.7% dividend, significant dividend coverage, dividend growth, trading at a multiple of 12 times earnings. So hopefully you find this information useful as you talk about the strategy with clients.